Hey everyone, Josh Martinez here, and welcome to this week's idea. Today we're going to take a look at silver. We're going to do a top-down analysis. All right, so the daily time frame, which means every candlestick represents one day, we're seeing a massive bullish trend. What I want to do is I want to apply the Fibonacci sequence starting from this lowest point. Now, manually applying the Fibonacci you can do, but I also like to use what's called the one-click fibs. And so I'm just going to left click over the lowest point, click one time. This will give me the latest Fibonacci count. So I have 1, 2, 3, 4, 5 Fibonacci's that have worked in a row, 6 Fibonacci's that have worked, 7, and we're on our 8th Fibonacci. Now, what Fibonacci's do for me is they help me understand direction, stop placements, and ultimately targets. Now, let me go ahead and just apply the latest Fibonacci's, and here we go. So according to the Fibonacci sequence, longer term, we are expecting that the silver will rally to 105.635. Now, when you measure that in regards to ticks, okay, with a full contract, every tick is valued at $25. What this is saying is we're going to expect 2, 3, 5, 7, so about 2, 3, 5, 7 ticks above. Now, and this is a daily up Fibonacci extension. So when we bring out our calculator, let me bring out a calculator. This is a massive movement. And so 2,357 ticks times it by $25 a tick is $58,925, assuming the research is true. However, we have, silver is a hot commodity right now. It's all over the news, all over the forums, and it seems like everyone is buying silver right now. So confidence of this market continuing to go up is relatively high. The issue with this opportunity is the risk is really big. So what we want to do to try to lower our risk is we'll just go to a smaller time frame, such as a 1 hour time frame. And on the 1 hour time frame, we want to look for buying opportunities towards the daily target. And we do this off the 1 hour time frame for the intention of lowering risk. And if we can lower our risk, great. And if we can't, we will probably go to a smaller time frames. Now, all we're going to do is when we go to the 1 hour, we're going to focus on the here and now, the most recent bullish trend, which is the market is making higher highs and higher lows. You can see the buyers are in control. This high is higher than this high. This low is higher than this low. And normally, not always, but normally the market will use or follow a Fibonacci sequence, especially when it's like trending quite a bit like it is right now. So starting from this low, we can see that we have 1, 2, 3, 4, 5 Fibonacci's that already worked. And this is Fibonacci number 6. Now, according to this latest Fibonacci sequence, we do have a 88.6 retracement, making the extension the 12.7. And if you don't know what that means, that's fine. I'll just give you the end goal of mine, which is going to be the price target, which is 94.705. So the next 1 hour Fibonacci extension is going to be price point 94.705. Now, how far away is this? Well, from where we currently are now to our target's like 229 ticks away. Earlier, I was looking at it was almost 300 ticks, but now we're down to 229. So anyways, the market's moving and a pretty substantial move. Like, if I bring out a calculator and if I were to measure 300 ticks times it by 25, it's about $7,500. If I measure 200 ticks times it by 25, it's about $5,000, assuming the research is right, not taking into consideration any sort of risk. Now, ultimately, the best place to put your stop will be below the one boundary, right? And so the issue is if I were to do that, you're talking about 1,591 tick risk, and with the $25 a tick, it's just not acceptable. So what do we do in this scenario? Well, what you do is just realistically, you just take that target. And the reason why we listen to these targets is because not always, but often, when or if the market touches the Fibonacci extension, the market predominantly retraces. right? And so if we are going to buy silver, we want to know where are the potential sell-offs, right? So like last time, that was a Fibonacci extension, you know, of our previous idea. You can take a look at it. It caused the sell-off. After the sell-off was done, the market kind of recovered. And so we're going to expect something similar, probably not exact, but something similar. And so there is opportunity to be had. There's 200 plus ticks, nearly 300 ticks, depending on the wave. But all we really need to do is go to the 5-minute time frame, do what we did last time. And let me do this. Let me go to SI. That's going to be for silver futures. I'll make sure this is a 5-minute time frame. And off the 5-minute time frame, I'm just going to carry over the 1 hour target, price target. And this will give us our end goal in mind, 94.705. And remember, the reason why we want to look to exit there is because the expectation is that the market will retrace after hitting 94.705. Now, it's not guaranteed, it's just the pattern in which we monitor, which is Fibonacci's. And so to do this off the 5-minute time frame, you're basically just trading zones. And you divide the market into a buy zone, sell zone. When or if the market comes near this top blue level, you can see the market selling off. We're starting to break that now. So the bear retracement appears to be coming to an end. And what we can do is we can wait for this market to give us a low higher than the previous low above the angle that pushes the market down. It's called past resistance becoming future support, and that could help push the market up. You can bring in a counter trend line, which is always a good idea. I love counter trend lines. I think they work really, really well. You give up some profit opportunity. You add on a little extra risk, but usually, not always, but usually you get a better experience where when you enter into the market, it tends to go your way right away. Now, if we were to draw the new uptrend line, you can kind of see how the new uptrend line is starting to take over. Off the 5-minute time frame, the market is starting to make higher highs and higher lows. So why do we do all this research? You know, why do we do all this? Well, we do this simply because, number one, we acknowledge the bigger picture opportunity, which is a lot, and then we acknowledge our problem, which is risk is too much. So we analyze the larger time frames to find the bigger targets. Then we acknowledge, hey, risk is too grand, and then we just go to a smaller time frame and for the whole intention of smaller risk. Now, when you go to a smaller time frame, you're going to deal with what's called market noise, emotionally driven market reactions, kind of unfair market movements due to announcements, etc., and so on and so forth. Well, it's kind of the trade-off, right? You get smaller risk, we got to deal with some of the headache. So in this particular scenario, we could do a couple things. We could reapply our Fibonacci sequence starting from the most recent bullish trend and just use Fibonacci's ideally from where we currently are now for stop placements. And it looks as if we just fulfilled the Fibonacci extension. So according to what we're dealing with on the 5-minute time frame, we're going to wait for a fractal high to form. And this really what we want is just where do we place our stop. So the best place to put our stop on the 5-minute time frame according to the most recent bullish trend will be 92.345. And the reason why I say best stop is because if the market takes out that boundary, then the bullish trend ends and the bears could take over. So according to Fibonacci's, that's the best stop, meaning that use this stop of 92.345, use this limit of 94.705, and that will give you the best chance to actually win this trade with not having such a big risk on the larger time frames. If you really want to press it, you could go for a smaller risk, right? However, you know, by placing your stop above the Fibonacci 1, you do subject yourself of getting stopped out first and then the market going your way, which is never a lot of fun. So according to the research, stop should go at 92.345, limit should go at 94.705, and then you just decide how you want to enter in. You could buy the market now, hope it just goes your way right away. You can wait for the next wave with low price in the buy zone, which I think is a really, really good idea. Or you can just go to a larger time frame and just kind of go with that. Now, what I ended up doing is I posted this idea on the profile. So if you go to tradingview.com and you search my name, Joshua Martinez, all one word. So as Joshua Martinez, right here, there's a little search button. So Joshua Martinez, all one word. You can see that I post these ideas throughout the week. And so if you click on this, you can see I outline on the 1 hour time frame, stop placement, limit placement, where you enter in is up to you. You kind of see that when I posted this, there was 294 ticks of opportunity, which is fantastic. And you can kind of see, I like this little play button. There's the before, there's the after. You kind of see, was I right? Was I wrong? You know, and kind of hold me accountable, which is always a good thing, right? You know, always look at someone's performance if you want to listen to them or not. So yeah, take a look at it. You can follow me. I have 5.9 thousand people following me, 312 ideas. But once again, this week's idea is focusing on silver long, big picture, 2,357 ticks bullish. 1 hour time frame, the next retracement should be somewhere around 94.705 off the 1 hour. Go to the 5-minute time frame, look to scalp the opportunities. And remember, there's risk involved in trading. There's no such thing as 100% absolutes or guarantees. You should only trade with money you can afford to lose. We are not CTAs. We are not financial advisors. Everything which I just shared with you is for the intentions of education only. I'm not telling you to enter into the market. I'm not telling you to exit the market. I'm just sharing with you information. Understand the risks involved in trading. Everything that I went over is a hypothetical example. It was not real money. It was a measurement from the number of ticks, and we backed into the dollar amount by using one E-mini contract and assuming if you were to trade an E-mini contract, what it would look like. Okay, my name is Josh Martinez. This concludes this week's idea, and have a wonderful day.